Micron is up almost 16% in a single session. Everyone is euphoric, and Envira's model says it's overvalued by 378%. Nvidia is down today, sentiment is flat, and the same model says it's still 15% undervalued. Same week, two stocks, two completely opposite signals, and almost everyone is about to make a decision based on the wrong one. Most investors don't lose money because the market is rigged. They lose money because their brain wasn't built for this. It was built to survive, to run from danger and chase safety. Trading and investing didn't exist when that wiring was formed. So every time a position moves against you, or every time you watch a stock rip higher without you, that ancient survival circuitry fires, and it overrides logic. There are 5 behavior patterns that come out of this wiring, and they show up in almost every investor at some point. Today, we'll walk through all 5 and use 2 real live Envira readings to show exactly where the emotional read and the data read split apart. Most people believe their biggest risk is picking the wrong stock, the wrong entry, the wrong indicator, the wrong setup. That's not wrong, but it's incomplete. Research consistently shows that experienced investors don't outperform because they have a better strategy. They outperform because they process risk differently. The fear response is still there, it just doesn't take over the decision. So the real edge isn't a better signal, it's knowing which of these 5 patterns you're standing in right now. Mistake 1. Cutting winners early, letting losers run. Loss aversion means losing $500 hurts roughly twice as much as gaining $500 feels good. So investors rush to lock in small wins and freeze when a position is red, hoping it comes back instead of taking the loss. Nvidia is down today. If you're holding it, that loss aversion wiring is telling you to panic. But the IQ score reads buy at 7.9 out of 10. Moat is wide at 8.0. ROIC is 70% against a 15.4% cost of capital. That's a business still creating enormous value. The fair value gap says the business is 15.7% undervalued, not in trouble. That's the gap between what your emotions are reading and what the model is reading. Mistake 2. Confirmation bias on a losing position. Once a position is down, the brain doesn't look for the truth. It looks for permission to keep holding. You scroll for the one bullish take that agrees with you and ignore the rest. Here's the nuance Envira is built for. Insiders and institutions are net sellers on Nvidia too. That's a real data point, and it's also not automatically a reason to panic. Insider selling at this scale often reflects personal liquidity, not a change in conviction. The point isn't to cherry-pick the bullish numbers or the bearish one. It's to look at all of them before deciding what you actually believe. Mistake 3. FOMO and revenge trading. This is the one almost everyone has done. A stock rips higher, you have no setup and no plan, but the fear of missing the move feels worse than standing still, so you buy at the top with no entry, no stop loss, nothing but emotion. This is what Euphoria looks like in real time. The stock just ran 15.74% in a single session. Sentiment is reading Euphoria at 84, and the IV engine puts fair value at $253.65, a 378.4% premium to where it's trading. That's not a stock that quietly became a better business overnight. That's a crowd chasing a candle. Buying here, with no plan, is the textbook FOMO entry, buying after the move at the worst possible price on emotion instead of a setup. Mistake 4. Letting the platform make the decision for you. Every push notification, every red and green flash, every "others are buying this now" banner is designed the same way social media is designed, to keep you reacting instead of thinking. Underneath the euphoria, the actual business picture is far less exciting than the candle. A narrow moat, a thin 1.4-point margin between ROIC and cost of capital. Value is being created, but barely. None of that shows up in a price alert. You only see it when you stop reacting and actually open the data. Mistake 5. Skipping risk management because it's boring. Position sizing and risk rules don't feel exciting, but the investors who survive long enough to get good aren't the ones with the best strategy. They're the ones who never let one decision wipe out the next 10. Here's the contradiction worth sitting with. Both companies pass Envira's financial health checks. Both are fundamentally sound businesses. The difference isn't the company, it's the price you'd be paying and the discipline you bring to the position size. That discipline is the part most investors skip. Looking at this pair, the data points in one direction. Nvidia's gap between price and fair value reflects a business that's misunderstood today, not deteriorating. Micron's gap reflects a crowd that's currently euphoric about a much more average business. I would treat a green pulse sentiment reading above 80 as a moment to slow down, not speed up. And I'd treat a smart money bearish signal as a data point to investigate, not a panic button. The goal isn't to predict the next candle. It's to know which of these 5 patterns is influencing the decision in front of you right now. Envira is in free for now. No credit card required. Run this exact breakdown, fair value, moat, IQ score, smart money, on any stock you're holding in under 2 minutes.